What are carbon markets and why are they increasingly important in the world today?
Yeah, sure. So carbon markets seek to do one thing, which is fundamentally to create incentives for companies to reduce their emissions and to invest in new green technologies. And as a policy, they've been incredibly effective, and as a result, they're expanding rapidly. So as of this year, 28% of global emissions are currently covered by some form of carbon pricing mechanism. And we've seen some fairly significant expansions in the last year in countries like China. We've had Turkey introducing and legislating an emissions trading system, also in Vietnam. So a lot of the emerging markets are introducing carbon pricing as a policy, while we're also seeing expansion in states like New York, which has also introduced a carbon pricing mechanism. So it's growing fast and having quite an impact.
There are areas where these intersect. Voluntary carbon markets obviously took off quite heavily in the early 2020s, saw a doubling of demand between 19 and 21, up to 180 million tonnes of credits retired, but we've seen demand maybe pull back a little bit, stabilise around those levels in the year since. I guess what are those factors that are driving the voluntary aspect of these markets?
Yeah, sure. So voluntary demand is, of course, a bit more volatile than compliance demand because companies get to make a choice about whether they're going to be buying and retiring carbon credits for voluntary purposes, whereas they don't get to make that choice for compliance mechanisms. And there's a couple of things that are quite key in driving demand in voluntary markets. So one is companies' emissions and the targets that they set to reduce their emissions. And two is their ability to pay. And we find that it's the ability to pay that is quite key in driving decision-making and purchasing behavior in the voluntary market. So if you look at an example at a company like Microsoft, it has both lots of emissions, near-term targets, and a high ability to pay, which kind of explains why it's been so active in carbon credit markets in the last couple of years. But this is really the exception rather than the rule. So in analysis that we've done, we've looked at over 17,000 companies globally, and only 1 in 90 companies has an ability to pay that is equal to or higher than Microsoft's. But over time, we expect this to change. So there's a couple of key drivers there. One is that emissions are flatlining or falling across the economy. And two, companies are continuing to increase their profitability. So taken together, that means the ability to pay for carbon credits is increasing. And if you project this forward out to 2050, this increases the number of companies that have an ability to pay similar to Microsoft's current levels from 1 in 90 today to 1 in 8 by 2050. So we expect that that's going to have fairly significant impacts on buying behaviour and to see a large increase in demand for high quality carbon credits over that time.
In such a fragmented market like this, like how do people, even like Microsoft or other maybe less sophisticated buyers, look at this market, decide what it is they want to look at, what they should not be buying?
Yeah, it's a really tough question, and lots of companies are struggling and grappling with this. There's a couple of areas that I would focus in on and being key for companies to understand. So one is the price and the cost of these removals. So as you mentioned, things like direct air capture are incredibly expensive. Things like nature-based removals, afforestation, reforestation are somewhat more affordable. But we expect there to be some limited convergence in these prices over the next few years. So in our forecast, we see the price of, say, afforestation and reforestation credits increasing by about 50% out to 2030, whereas the price of, say, biochar, BECCS, so bioenergy with CCS, and direct air capture credits will probably halve over that time period as you move to more industrial scale production and therefore costs are reducing. So price is one big factor. The second big factor that I think everyone is focused on is quality, or at least different interpretations of quality. So this goes to some of the fundamental environmental attributes of carbon credits, so things like additionality, which is the question of whether a project is actually driving a change in behaviour relative to a certain baseline. Or, as you mentioned, things like permanence, which for removals credits is about how long can you expect carbon to remain sequestered. And companies are looking at various different metrics to try to understand this alongside other things like biodiversity and social co-benefits. But of course, it's quite difficult for companies to come to an independent view of what is a high quality credit when there's more than 10,000 projects that are operating at this point in time. So they tend to focus on how can they use third-party resources, things like carbon credit ratings, to get an independent, objective view on the quality of some of these different projects.
And you touched on ratings there. I know it's something from my side we've been looking at quite closely over recent months. We've recently launched a suite of project-based ratings assessments based off of B0 ratings prices, where we obviously try to distill down to what price impact is that ratings having. So by banding them within project types, trying to remove that noise of, hey, reforestation will typically price different to a red avoided deforestation within different ratings bands. So trying to distill what's a triple B rated ARR versus a B rated ARR. And we've only done a week or so of these assessments, but even in that kind of like initial data, we do see higher rated projects within these bands achieving premiums. Something like an ARR project, a triple B rated on average, is 10 to 12 times higher priced than a C rated project. Whereas something like an IFM, you see about a 70% uplift between a B and an A-rated project. Red, avoided deforestation, is maybe a little bit noisy. There's a lot more project-specific factors that go on. So you'll have certain things like tight supply or maybe regional differences that will spur buyers onto certain projects. But even there, we see a 50% uplift per rating band between a C and a triple B. So there is, I think, quite a lot that buyers and sellers are able to look at within this market and be like, hey, this is quality, this is the price premium I should be getting.
And that's some really important differences to understand. Like if you're coming into this market cold, that would be quite surprising, that level of premium. Particularly you mentioned in ARR of being a 10 to 12 time premium between the lower rated and the higher rated credits there. How do you expect buyers to use these ratings?
I think we've seen buyers become more discerning in what they want to look at, what they want to purchase, particularly over the past few years when there has been these integrity concerns raised within the market. I think buyers don't want to get caught out in any either overcrediting or greenwashing scandals. They want to make sure what they're buying is a ton of carbon. And these ratings give buyers a sense of quality, basically. Hey, this is what we're buying. It's got an independent third-party rating. I think particularly for maybe smaller buyers who don't have large internal due diligence teams to be able to look at every single project and form their own opinion, these ratings help people to look at what they should or should not potentially be buying. And even in the market at the moment, we've seen when projects either get re-rated higher or lower, an impact on pricing. So if we look back earlier this year to a project like Kattingan, a Indonesian Red Plus project, was originally rated A by B0 and in February got upgraded to a double A. Since then, we've seen pricing for vintage 20 credits from that project rise from, at the start of the year, about $455 or so to, as of the end of June, $750 to $850, which is obviously a very sizable increase.
Big movement, right?
Big movement, and part of that is down to buyers seeing it's rated higher. It's a better project. It's been uplifted from where it was and increasing that demand. There are some other factors at play with a moratorium recently on issuances by the Indonesian government, which has maybe artificially tightened supply and also helped to bolster, but there is still this ratings factor that is at play. And we've seen it maybe to a lesser extent on ratings downgrades as well in the past few months. A mangrove restoration project like Delta Blue Carbon got re-rated down the other month, triple B down to double B. We saw less of a price impact on that, but we did see offers in the week after the re-rating fall by about 50 cents or so. They've since stabilized. And again, there's these maybe other factors in terms of supply and there not being much credits from mangrove type projects that are maybe lessening the fall on these.
But it seems an increasingly important factor to manage when you're thinking about risk as it relates to some of these carbon credit projects. One thing I did want to ask about is, beyond some of the ratings, a lot of the price assessments that you and your team do also look at other kind of variants in terms of how projects are structured. Could you talk through some of those?
Yeah, so like particularly if you look at, say, take our ARR reforestation assessments for example, our initial suite that we launched in December of last year, very regionalized, so focus on Latin America, where a bulk of the supply, a bulk of the trade happens in these markets. And we've tried to, again, distill certain aspects that people may view as quality in that market. So our headline assessment looks at multi-species, which typically attracts a premium compared to single species. And on top of those, we do differentials, so a premium for planting native species, whereas a discount for planting single species. On top of that as well, there's registry differentials. So if you look at something like a Vera issued project versus a gold standard issued project, at the moment, there's about a $10 or so price difference between similar projects within the region. However, part of that is down to methodologies, whether we'll see that change as credits issue under Vera's new VM47 methodology, let's see.
Yeah.
But that is one of the aspects we're looking at. Elsewhere, something like a US improved forest management credits, we're trying to distill the removals portion from the avoidance portion. We touched on this earlier around the removal side of things, but certain buyers prefer removals credits, and there's a sizable premium developers and traders are able to achieve for that removals tagged portion. So we're trying to distill what is that price premium for a removals credit. And sometimes you see these developers focusing on those removals because maybe the avoidance is lower priced and they can maybe make up the demand on the removal side of things.
We have seen some big deals in the last year in the improved forest management segment of the market. And actually, when we talk to a lot of our kind of clients within the forest value chain, they're telling us that carbon is becoming an increasingly important factor in making decisions both around land acquisitions, but also the operation of some of their forest portfolios. What we've seen is over the last kind of 5, 6, 7 years, a continued expansion in carbon crediting projects on US forest lands, such that now around 10 million acres of forest land in the United States is covered by carbon projects, and that's growing at about 1 million acres each and every year. So for forest owners, carbon's providing them a new revenue source. It is something that can help manage the volatility that they see, for instance, as regards to lumber prices and with broader macroeconomic sentiment. So carbon's becoming quite important to help smooth some of those fluctuations and to add value overall to the portfolio of forest holdings.
We've spoken about compliance markets briefly at the start, but obviously they're a growing source of demand and carbon price coverage globally at the moment. So I guess the question to you is, what are these main compliance markets and kind of which ones are the ones to keep an eye on?
So when we're thinking about compliance demand, there's kind of 3 things that we look at. The first is the International Aviation Offsetting Mechanism, known as CORSIA, which we expect to drive somewhere between 150 and 200 megatons of additional demand over the next few years. But this is a mechanism that's only going to grow in impact over time. If you look out to, say, the mid-2030s, demand could easily be in the 250 to 300 megatons level per year. So it'll be a really substantial driver of demand. On top of that, we also see countries starting to collaborate more through the purchase of carbon credits to meet their international commitments under Article 6 of the Paris Agreement. So this is countries like Japan, Singapore, Switzerland, Sweden, that have made commitments to use international flexibility mechanisms, so carbon markets, in order to meet their targets. We see this driving potentially another 100 megatons or so demand by 2030. And then there's the other mechanisms that I mentioned earlier. So compliance mechanisms like the California ETS, the South African carbon tax, the Colombian carbon tax, that allow the use of carbon credits to meet obligations under these mechanisms, and that might drive another 50 megatons of demand in 2030. So if you start adding these up, you're talking about hundreds of megatons of demand year on year, which is a substantial increase from the size of the current market today, and that's only from compliance mechanism. That's before you even take into account voluntary demand. I guess it is a challenging market to model and forecast, which is why that we look at scenarios and we try and dig into the detail. So what we have done in terms of our forecasting is to look at each and every international airline that will have obligations and on a route by route basis and try and forecast what their demand for CORSIA eligible credits might be over the next few years. We've also tried to look at all of the project on a project by project basis to understand where are we likely to see significant supply come online in the next few years. And basically what we expect is that there's actually going to be fairly tight supply in the first phase of CORSIA that is likely to see prices increase relatively substantially, but not astronomically over the next few years, before tailing off in the latter half of the 2020s as we move into phase 2 and more supply comes online. So a near-term kind of tightening and a longer-term, I guess, relaxation in the tightness of the market.
How do you see maybe US airlines operating in this space?
Yeah, this is a big area for uncertainty and one that we're looking at quite closely. And from the discussions we've had, I think it's also one where the US airlines are looking at this quite closely and thinking about how do we best respond. Because of course they might be regulated within the US, but they are operating globally. And non-compliance with CORSIA is very likely to garner a response from other jurisdictions, particularly thinking about the European Commission, which of course has tried to price international aviation emissions within the EU ETS previously. So I imagine that US airlines would be wanting to do whatever they can to avoid the potential pricing under something like an EU ETS mechanism in future, which suggests that maybe CORSIA could be a preferable option.
First off, what is CBAM, and kind of how do you see it impacting current markets?
Yeah, sure. So the carbon border adjustment mechanism that's being introduced by the European Commission is fundamentally about trying to level the playing field between domestic production of emissions-intensive goods, so things like steel, aluminium, cement, fertilizer, and those goods that are being imported from third countries. And the way that it does this is basically by trying to export European carbon pricing onto those imports. So, of course, most emissions-intensive industries within the EU are subject to a carbon price through the EU emissions trading system. That creates a price incentive, and the carbon border adjustment mechanism tries to replicate that incentive for imports so that higher emissions imports become more expensive, lower emissions imports become less expensive and more competitive. And so you see European industry not being disadvantaged against some of those higher emissions imports.
The EU has been a leader in terms of carbon pricing, with obviously EU ETS, with CBAM coming in. I guess, how do you see this developing? How do you see the EU kind of laying out these markets going forward?
Yes, certainly. So I do think it is correct that the EU has been a leader on carbon pricing. Of course, it started off with the EU emissions trading system in 2005. It's now been running for 20 years, and it's been a key driver of decarbonisation across Europe. And I think what we've seen in the last few years is the European Commission really doubling down on carbon pricing. Because if you think about it, some of the key policy mechanisms that it's introducing are about the expansion of carbon pricing. We've got the carbon border adjustment mechanism, which applies carbon pricing to emissions-intensive imports. We have the expansion, the EU ETS 2 mechanism, as it's known, which will cover buildings and transport emissions, so covering a large chunk of currently unpriced emissions within Europe. And of course, we have the ongoing discussions around the introduction of the carbon removals and carbon farming initiative that could see price incentives extending to things like sequestration through land management techniques, but also through things like tech-based removal projects. So overall, the EU is basically taking its carbon pricing mechanism and expanding it much more broadly across the economy as a way of driving decarbonisation in a cost-effective way.
And I guess following up from that, we probably see the EU double down on carbon pricing. One of the implications we seem to see or hear about is its impact on other countries. Of if the EU is doubling down on carbon pricing, We see an expansion of ETSs globally. Obviously, like Turkey's just legislated for its own ETS. You're seeing other ETS schemes pop up around the world. I guess, how do you see the global impact of the EU's policies playing out?
Yeah, I think that's a really interesting kind of driver that's sometimes underappreciated is how do these policy mechanisms expand over time, and what is the kind of diplomatic effort behind that? Because I think we have also seen Europe decide that it wants to play a role in pushing carbon pricing more expansively globally. And it has had an impact already on places like Turkey, as you mentioned, has now legislated its emissions trading system. But we also see other jurisdictions looking at implementing their own carbon border adjustment mechanisms, places like the UK, but it's also being discussed in places like Australia, in Canada, and Japan, and is at different levels in terms of its development in those jurisdictions. So we kind of expect that progress might be slow in expanding carbon pricing, but it's pretty consistent in seeing the growth in these mechanisms over time. And over the next 10, 20 years, it's going to be more and more a feature that industrials and different commodity traders, participants in these markets need to take account of when it comes to their existing operations.
Speaking of CBAM and EU doubling down on everything, this will obviously have quite an impact on industrial commodity markets, industrial players within and outside the EU. I guess, what do you see as the impact on those guys?
Yeah, so I think there's a couple of impacts that are quite important here. So one is the direct cost impacts kind of that we already know about. And then two is the policy uncertainty around the policy as a whole. And if you look at the cost impacts, they're quite significant. In 2026, we expect costs of around 9 billion euros if trade flows remain the same, and that could increase to 22 billion euros by 2035. And this is predominantly falling on some of the large emissions-intensive import sectors like iron and steel, which I think is responsible for about 75% of those costs, but also significant costs for aluminium, for fertilizer, for cement as well. So these costs, of course, are having a large impact on decisions around how companies are structuring their supply chains, and even if certain producers are choosing to sell into the EU markets or sell elsewhere. So we are seeing that there is an ongoing process, particularly from downstream buyers, making decisions about, okay, do we need to strategically rethink the shape of our supply chain? Do we need to look at moving to other suppliers that have a lower carbon intensity of their production and avoid some of the producers that have high emissions intensity that is only going to increase in costs over time. Now, the second point on policy uncertainty is a much harder one for clients to manage because there are, of course, outstanding implementation decisions that the European Commission needs to make around things like the benchmarks for the application of CBAM liabilities, but there's also fairly significant policy changes that they flagged. We're expecting policy certainty around potential for export rebates as it relates to CBAM within the next few weeks. But in the longer term, there's questions about the expansion of CBAM to downstream sectors and how that could affect the overall incentives and decisions around things like supply chains as well. I think if you talk to people within these industries at the moment, there's a mix of kind of scratching their head or tearing their hair out when it comes to CBAM. And what we're trying to do is to just provide a little bit more understanding about how could CBAM and some of the policy uncertainties that exist affect their specific operations, and then how could it affect the development of the broader commodity market. So a couple of things that we've developed is one, a quite detailed cost calculator to help companies, I guess, understand their relative exposure to CBAM and benchmark it against others within the industry. And we are in the process of developing our kind of trade flow modeling, which tries to take a more aggregate look at the impacts of CBAM to understand, okay, what impact might it have on the final cost and the final price of some of the covered commodities? How will those costs be passed through, and how much of that is likely to fall on the end consumer versus the producers and importers of these goods? In order to understand, okay, what's the long-term trajectory for how commodity markets might change, how trade flows might shift, and the implications that might have for competitiveness of different players within those supply chains.
Fastmarkets already covers pricing in the voluntary carbon space as well as Corsia. We already have analytics on the voluntary side of things, and you mentioned earlier about CBAM and looking at that. What's next for Fastmarkets? What are we looking at in the next 12 months or so?
So across all of the sectors that we work in, so metals, mining, forestry, agriculture, carbon markets and sustainability is having a significant impact on competitiveness, but also creating opportunities for companies to grab, to make the most of kind of growing demand for green commodities as part of the climate transition. So what we want to do is to help our clients navigate that transition. So part of that is understanding specific markets like carbon credit markets, understanding specific policies like the impact of the carbon border adjustment mechanism, but we want to expand our coverage both to other kind of compliance carbon mechanisms globally, but also to develop a better understanding of how green commodity markets might develop over time. So things like how will demand for green steel change as a result of both voluntary drivers, but also drivers such as CBAM. How do we expect sustainable aviation fuel to scale over the next decade? So these are all questions and areas that we're looking to address in the next couple of years.